All right. Hello and welcome, everybody. Happy New Year to everybody. Today, I want to start what is going to be really our very first weekly chat that we're going to have here on the Facebook page. Normally, this is going to be held at 8 p.m. Eastern Time on Mondays. Today's Tuesday. Got started a little bit late on it this time around, but typically we're going to be here 8 p.m. every Monday, and we're going to do a deep dive into some sort of financial topic. Typically, these are going to be driven by questions that people either ask me in person while I'm out and about here in Philadelphia, or are submitted through the website or through this Facebook page. And I'll just kind of share my response with everybody here. So if you have an idea, anything you're kind of curious about hearing, shoot me either a message or leave a comment on this video. Would be more than happy to talk through it with you all on this page. So I have a few questions we'll be covering over the next few weeks. But for today, I want to talk about something kind of that I think is timely given the current events that are out there, and that is the potential side effect, if you will, of the passage of the recent tax reform law that was passed right before the end of the holidays, and a new opportunity I think that's out there for student loan borrowers, particularly borrowers who are on an income-driven loan repayment plan. So primarily, just to give you a heads up in advance, this is going to involve, apply to people who are on an income-driven repayment plan, their student loans, who are married. Now, if you're not married yet, and you're on one of these plans, but you see yourself potentially getting married over the course of your student loan payment life, stick around, right? Maybe you'll pick up on some stuff that'll help you someday down the road. But again, this is primarily an effect that's going to be applicable to student loan borrowers who are on an income-driven repayment plan who are married. And before we dive into exactly what that is, I think it's worth noting. We did a deep dive into the Tax Cuts and Jobs Act on this page right after it was passed in December 2017. We're not going to rehash that today, but just to reiterate, there are no direct effects of that law on student loans themselves. There were a lot of rumors going out there, going on throughout the whole legislative process in Congress that there were going to be some changes made, particularly to your ability to deduct student loan interest. None of that happened. So everything in that light is exactly the way it was before. If your income is below certain thresholds, you're still able to deduct up to $2,500 in student loan interest from your taxes per year. Nothing's changed in that light. What has changed, though, are the ways that we calculate student loan payments under these income-driven repayment plans, or at least the potential to change them. So what do I mean by that? And I guess the starting point for this needs to be, right, what is an income-driven repayment plan? Right. So for those of you who are unaware, for those of you who are not on one of these yourself, right, typically when you borrow student loans, you graduate from school, you have a 6 to 9 month grace period before you need to start making payments. And your student loan servicer is going to put you on a standard 10-year repayment plan. They'll tell you how much you owe based on how much you've borrowed and the interest rate and things like that. You make the monthly payment that they tell you to make, and 10 years later, it's completely paid off, and you're good to go. But for most student loans, not all of them, but most, if you have a particularly high amount of student loans, particularly compared to your income, you have a few options, and one of them is what I'm going to call today these income-driven repayment plans. There are a wide variety of income-driven repayment plans. We're going to treat them all as the same thing today, even though they're not, right? There are some pretty substantial differences between them and who can qualify for what. If you want some more information on that, go ahead and download our free student loan guide. It's about 30 pages long. It's the most popular giveaway we've ever had on our website. It'll walk you through exactly what you need to know about all these different income-driven repayment plans and what they consist of, and help you identify which one's right for you. The link for that is in the video description. So go ahead and download that if you have more questions about that. But generally speaking, as a whole, these income-driven repayment plans tie the amount you owe every month on your student loans to your income level. So if you aren't making a lot of money, or you just have way more in student loan debt than your income, it essentially allows you to scale back your student loan payments to a reasonable level based on your income. The question, though, is what counts as your income? Now, if you're single, this is pretty straightforward, right? Your income is your income. Whatever you make at your job, any other income you have, that's what they base it on. Nothing too complicated there. But when you're married, it's a little bit more complicated, right? Because now you have your income, and if your spouse works, they have income as well. So what does your student loan servicer base your payment on? Is it based on just your salary, or is it based on you and your spouse's? Obviously, if your goal is to lower your student loan payment, you want to have it be based on a lower amount, right? So ideally, you just count your own salary. The answer is that they actually let you choose which one to use. You can either report just your income or your spouse's income. You have the choice. So why is this a no-brainer, right? I mean, like I said, if you have the option to pay your loans based on a lower salary versus a higher salary, your monthly payment's going to be lower. Just reporting your income. So why wouldn't you do that? And unfortunately, there definitely is a catch to it. And the catch is this, right? However you decide to report your income to base your monthly student loan payment on, you need to file your taxes that same way too. In other words, if you want to report just your income to lower your student loan payment every month, you need to file your taxes separately from your spouse in order to do that. Or conversely, if you are married filing jointly, then they're going to look at both you and your spouse's income when they calculate what you owe on your student loans every month. Now, for most couples, you're going to save more on taxes by filing jointly rather than separately. There are some big exceptions to that, and I put on the Paysetter Planning blog last year a list of some of those particular exceptions. But typically for most couples, particularly for most young couples, you're going to find that you're going to save more on taxes by filing jointly rather than separately. But that means you're going to owe more on student loan payments because you're filing jointly and they're basing it off the bigger income number. You can almost think of it as like one of those balance scales that we used to have like in elementary school, right, where you're weighing one thing against the other. On one hand, we have the amount of taxes you're going to owe. If you file jointly, that's going to be a lower number. If you file separately, that's going to be a higher number. And on the other hand, we have your monthly student loan payment. And that works the exact opposite way. If you file jointly, you save on taxes, but you owe more every month in student loan payments, and vice versa. If you file separately, you're probably going to owe more in taxes every year, but you're going to save every month on student loan payments. And you can imagine, right, there's a point where that's going to balance out. In other words, let's say, for example, that if you file jointly, you're going to save $2,000 every year on your taxes compared to if you file separately. But doing so might cost you an extra $2,000 in student loans, for the whole year across all your monthly payments. If that's the case, then it doesn't really matter what you do, right? You're going to save $2,000 on taxes, pay an extra $2,000 on your student loans every not every month, but across the whole year. It all washes out. But typically it doesn't balance out. There is going to be a better answer for you whether or not you should file separately and reduce your student loan payments, or file jointly and pay more every month. Usually there's going to be a clear-cut answer. And that brings us all the way back to this tax reform bill. Because what this bill has effectively done, it's not intentional that it worked out this way, but it is the effect if you're on one of these repayment plans, is that what it's done is the way they calculate your student loan payments hasn't changed, right? Your income's still the same, right? The options are still the same, but they've reduced the other side of the scale for most people. Most people are getting tax cuts, which means the gap between how much you're going to owe married filing jointly versus married filing separately is less than it was under the old tax law for most people, right? They've taken this equilibrium and thrown it off a little bit, which means that there's going to be more people who are better off filing taxes separately and taking the lower student loan payment every month than there was under the old tax law, right? The balancing point has shifted, which means more people are going to be better off filing taxes separately than they were under the old tax law. Now, just to be clear, right, you still are, for most people, owe more on taxes filing separately than you would if you filed jointly, right? That hasn't changed. But what's changed is the magnitude, right? If the overall dollar amount of your taxes is going down, and just with the way that they drew the brackets, for most people, the gap between what you owe filing jointly versus filing separately has shrunk by a real dollar amount, which means that for more people than there were before, right, you're going to be better off filing separately and reducing student loan payments every month. Not for everybody, right? There certainly still be some people who are better off filing jointly and paying more, but you need to go back and revisit the math, because the math has fundamentally changed as of January 1st this year. Now, the good news is that you have the ability to decide this every single year, right? If you're already on one of these income-driven repayment plans and have already been filing taxes jointly and reporting that higher income number, you can change that every single year. Every year you file your taxes and you have to recertify your income level. If you're on one of these plans, you've gone through this before. So I'd invite you to revisit it, right? Try to figure it out on your own, right? Are you still better off doing what was the right thing for you under the old tax law, or has it changed? Because there's a very real chance that it could have potentially changed. And if so again, if you're on one of these plans and you're filing jointly right now, take a hard look at it, make sure it's the right option for you. And if you qualify for one of these income-driven repayment plans and just haven't gotten around to it, right, there may be even a slightly higher benefit to you than there was before, right? It might be a little bit more of an attractive option now than it was under the current tax law. So I'd invite you to take a look at that. Now, just a couple quick details that I think are important to note before we wrap up here today. I've tried to keep this at a fairly conceptual level, but there are some key details you need to be aware of. So I mentioned before that there are several different types of these income-driven repayment plans. Primarily, there are 5 different types. You need to be aware that one of these 5 main types of income-driven repayment plans actually doesn't give you the choice to separate your income out, right? So we spent this time talking about you have the choice to file separately or file jointly and report your income likewise. If you're on one of these plans, you don't have that choice. The plan in question is called the Revised Pay-As-You-Earn plan. Sometimes you see it abbreviated as REPAY, REPAYE. If you're on that plan, you still don't have the option to split it up. You need to report you and your spouse's income jointly, which means that if this is something you're looking into, or like I said at the top, if you're single now but you're envisioning potentially being married later on down the road, you might want to think twice about going on that particular repayment plan. Right now, there are unique benefits to the Revised Pay-As-You-Earn plan that it's not worth kind of forsaking it altogether, but it is something you should take into account, right? That under the Revised Pay-As-You-Earn, you won't have the ability to separate the income out. And like I said, that might be a little bit more of an attractive option for many people now than it was before. And to be clear, like I said, I'll say it one more time, it's Revised Pay-As-You-Earn. There's another income-driven repayment plan called Pay-As-You-Earn, which does give you the ability to separate it out. Congress has really mucked up the student loan laws, over the past decade or so, with an assist from the Department of Education. There's a lot of different types. They all kind of sound the same. We're talking about Revised Pay-As-You-Earn, not Pay-As-You-Earn. Secondly, on a kind of a different note, right? This principle about weighing the balancing scale is correct, but it's a little bit more complicated than I laid it out here today. I wanted to explain it as clearly as possible. But there's one other factor that you need to take into account before you decide to file separately and lower your student loan payments. And that is when you do that, when you file separately, you lose the ability to claim that student loan interest deduction that I mentioned at the top. Right, so right now you can deduct $2,500 from your income in student loan interest payments. You can still do that if you file jointly, as long as your income doesn't exceed the relevant thresholds. But if you file separately, you can't. You lose the ability to do that. Right. So again, the concept is the same, but you can almost think of that as a little bit of an extra thumb on the scale that makes filing jointly a little bit more beneficial. Right. The principle stands. More people today are going to be better off filing separately and reducing your student loan payments than there were under the old tax law. But there is a second factor that you need to consider as well. And I guess to wrap up, that kind of leads nicely into this idea that this is fairly complicated stuff, right? Like I said, the way that we've kind of come to our current student loan landscape doesn't make a ton of sense. And this is something that I clearly help my ongoing financial planning and investment management clients do this sort of analysis to figure out what steps need to be taken all the time. But I actually offer a separate standalone student loan analysis on a separate basis, right? So for people who don't want or can't afford or don't have any interest in doing full comprehensive financial planning, I do offer this just as a separate thing. We would sit down, meet for 45 minutes to an hour. I'd collect your individual student loan data so we could get a feel for what you qualify for, talk about what your goals are with your loans. Are you trying to minimize your monthly payment, or are you trying to pay them off as quickly as possible? Those are two good answers for different circumstances, but they're complete opposites, right? So we talk about all those things. Within 48 hours, I'll get you a list of recommendations for what to do with them. If that's something you're interested in or learning more about, I do offer free consultations. So if you go to paysetterplanning.com/contact, you can set up a free consult about that to talk through this issue that we're talking about today. Like I said, kind of in closing, I think there is a very real unintended consequence that came about through this change in tax law that really is an opportunity for a lot of people if you decide to take advantage of it. So I encourage you to do so. Again, Happy New Year. We're going to be holding these video chats once a week, every week, typically on 8 p.m. on Mondays. And if you have any questions or things you'd like me to cover, go ahead and shoot me an email or leave a comment on this video. Thanks so much. Have a good day.